The Australian Balance of Payments, the BOP. The Australian Bureau of Statistics, ABS, defines a balance of payments as a statistical statement that systematically summarises the economic transactions of an economy with the rest of the world for a specific period of time. It shows transactions between residents and non-residents of that economy. The ABS releases the BOP data quarterly on their website. Just search catalogue number 5302. So, the BOP shows all transactions in and out of an economy, Australia, over a given period of time. It has two components. The first, the current account. These are transactions which are current in nature and are non-reversible, i.e. they cannot be undone. The transactions contained within the current account are goods, services, primary income and secondary income. The second part is the capital and financial account. This is a combination of two accounts which are reversible, i.e. they can be undone. They are the capital account. These are transactions of acquisitions, disposals of non-produced, non-financial assets and capital transfers. Don't worry, we'll get these soon. And the financial account. Transactions in foreign financial assets and liabilities between residents and non-residents. Let's start with the current account. Within the current account, there are four categories: net goods, net services, net primary income, and net secondary income. When we say net, it is a difference between a credit and a debit. Credit, money that flows into Australia. For example, money paid to Australia from China for the export to China of iron ore. While a debit is money that flows out of Australia. For example, money paid to Germany for an imported Volkswagen Golf. The ABS shows credit entries with an implied positive sign and debits with a negative sign. In 2016-17, more money left Australia than came in for net services, net primary income and net secondary income, i.e. the debits were greater than the credits. The BOP focuses on transactions between residents and non-residents. So, any transactions between residents and residents or non-residents and non-residents do not appear here. So, the four categories, what are they exactly? Net goods. These are physically produced items. A credit will be money paid to Australia from overseas for a physical item, like China paying for iron ore exported. While a debit will be money paid for an import for a physical item, like when I bought my Volkswagen Golf, the money went to Germany. Net services. These are services rendered. A credit would be a UK backpacker paying for a holiday to the Great Barrier Reef in Australia, while a debit will be money going to Harvard University in America if I decide to study there. We call the sum of the net goods and net services the trade balance. Our next two. Net primary income is returned from the factors of production. So land returns rent, labour returns wages, capital returns interest, and entrepreneurship returns profit. A credit would be dividends paid to an Aussie from a UK company, while a debit will be rent from an Australian property back to a Chinese investor. The final category is secondary income. This is income with no return. Huh? You ask? These are things like insurance claims, pension, and aid for food. A credit would be a pension paid from the UK government to an Australian resident, while a debit would be a foreign aid for food from the Australian government to PNG. So income with no return, unlike the primary income. We call the sum of net primary income and net secondary income the net income balance. So, the current account are all non-reversible transactions which are current in nature. In 2016-17 in Australia, it was negative 29 billion, i.e. more money left than came in. So, what's the trend of Australia's current account, you ask? Let's have a look. Since 1960, Australia has had a surplus in the current account only 3 times, 1962, 1964 and 1973, so not often. When the current account is in the deficit, we call it a current account deficit, or the CAD. The other component is the capital and financial account. These are reversible transactions, i.e. they can be undone. The first component is the capital account. The capital account relates to capital investment and consists of 2 main components. Acquisitions and disposals of non-produced, non-financial assets. Purchase of sales of intangible, non-financial assets such as patents, copyrights, trademarks, franchises and licenses. While we have capital transfers, conditional foreign aid grants and net forgiveness. In 2016-17, the total value of the capital account was negative $762 million, tiny when compared to the $29 billion current account. The second part is the financial account. The ABS defines this as transactions in foreign financial assets and liabilities, such as shares, bonds and loans, between residents and non-residents. Now, this doesn't have credits and debits, rather assets and liabilities. The ABS defines these are: assets are financial claims by Australian residents or non-residents, i.e. Australian investments abroad, e.g. an Australian bank lends money to non-residents. While financial liabilities are financial claims on Australian residents by non-residents, e.g. an Australian company issues euro bonds which are held by non-residents. The 5 categories of the financial account are: direct investment, which is investment by a resident in another economy of 10% or more of the voting power. Portfolio investment, this comprises of bonds, notes and money market instruments. The owner is not assumed to have any influence in the operation of the enterprise. Our financial derivatives, which are used for risk management hedging, a bridge and to generate a return. Other investment transactions not classified in the other areas, and reserve assets, foreign financial assets owned by the central bank, i.e. Reserve Bank of Australia. Now, don't get too caught up in the definition of each of these. Just know that they are the direct investment, portfolio investment, financial derivatives and other investments and reserve assets in the financial account. But, Mr. Ward, you've made a mistake. Some assets have a negative sign. I haven't, because Mr. Ward doesn't make mistakes. The ABS states that for foreign assets, when position data in any transaction increase or other flow increases in assets is shown with a negative sign. Transaction and other flows in assets are shown without a sign to denote a decrease in assets. While foreign liabilities, position data in any transaction increase or increase in the flows in liability is shown without a sign. A negative sign for a transaction and other flows denotes a fall in liabilities. The financial account in 2016-17 was $25 billion. I present to you the balance of payments for 2016-17 for Australia. The BOP uses a double entry system of accounting. In principle, the sum of all credit entries is identical to the sum of all debit entries, and the net balance of all entries in the BOP is 0. In 2016, the summary of the current account and capital account equaled 0. Well, nearly. The ABS concedes this does not happen. So, to make the balance of payments equal 0, there is one more category: net errors and omissions. And this is under the capital and financial account. A number is put in here to make the BOP equal 0. So, ta-da, the BOP. And here is the BOP broken down. On the left, we have the current account, which are current transactions, non-reversible transactions. It comprises net goods, net services, net primary income, and net secondary income. For each category, there are credits, money coming in, and debits, money going out. In 2016-17, it was negative $26.469 billion. Since 1960, the current account has been in surplus 3 times, 62, 64, and 73. Its volatility is linked to the trade balance, i.e. the sum of net goods and services, which we'll look in another video. While on the right, we have the capital and financial accounts. These are reversible transactions. We have the capital account with only negative $762 million, and the financial account with its 5 components: direct investment, portfolio investment, financial derivatives, and other investments and reserve assets. In 2016-17, this was worth $25.37 billion. To make the balance of payments, balanced, the net errors and omissions was only $4.858 billion. Therefore, the current account was negative $29.469 billion, and the capital and financial account was positive $29.469 billion. So, in 2016-17, the balance of payments was 0, just like in 15-16, and just like it will be in 17-18. It will always equal 0. It's a double entry system. So, Looking at the BOP itself is useless. It's always zeros. But looking at the components shows a story, remember. The balance of payments is a statistical statement that systematically summarizes the economic transactions of an economy with the rest of the world for a specific period of time. It shows transactions between residents and non-residents of that economy. All information for this video comes from the ABS website. Just go to www.abs.gov.au. Search catalogue number 5302 and you can get all the data here.